On Friday, May 17, 2020, retail investors were pouring money into futures believed they found a once-in-a-lifetime opportunity for rapid wealth accumulation from deep discounted resource futures. Today's story is about what happened on the futures market on May 17, 2020 and May 20, 2020. If you enjoyed this video, please click the like button and subscribe to our channel. Thank you. Since the start of the year 2020, oil prices have plunged after the compounding impacts of the coronavirus and a breakdown in the original OPEC Plus agreement. There are signs of weakness everywhere. Despite the weakness in headline prices, retail investors are continuing to plow money into oil futures. The U.S. oil fund ETF saw a record $552 million come in on Friday, April 17, 2020, taking total inflows in the week to $1.6 billion. If you enjoyed this video, please click the like button and subscribe to our channel. Thank you. On May 20, 2020, Monday morning, the May contract price plunged to $2 as traders wanted to flood the May futures contract ahead of its expiration tomorrow. The following month's June contract fell 12% to $22.05 a barrel, making the spread between the 2 months blow out more than $20. Rollover of contract become almost impossible. It seems that it is good time to buy crude oil, a blue-chip asset, at deep discount price, $2. Especially when you can hedge it by selling June contract at $20. If you don't buy this idea, how about when the price went down to 10 cents, and then to 1 cent? On April 20, 2020, a significant amount of contract were sold to those buyer who believed that it is a once-of-lifetime to buy such deep discount crude oil. As the price is so low that they can buy large amount of contract at a couple $1000s. They believed that the worst case is price to go zero and ignore the fact that light sweet crude oil, CL, futures are physically delivered upon expiration. Some investors saw the price go to zero and stop there. Unfortunately, what they saw was illusion, or you can say that this was a bug. Brokers kept the futures min price to zero because entering a negative value to contract price was considered only possible when there is fat finger incident. Actually, on 2:47 p.m. Eastern Daylight Time, oil futures collapsed to below zero for the first time ever as the deepening economic turmoil caused by the coronavirus crisis left traders desperate to avoid taking delivery of physical crude. Unfortunately, investors were not able to enter stop loss or limited order because their broker's system capped the floor price of futures to zero. Before that day, entering a negative value to contract price was considered to be a fat finger incident. The market finally settled at negative $37.63. Which mean that the buyer who paid $10 for one contract in the morning had to pay the seller $37,630 more. The incident raised litigation when some mutual fund wants to recourse the loss from holders as well as some investors accused the system bug avoid them to cut loss below zero. Interactive Brokers LLC, NASDAQ, IBKR, said it has been forced to cover $104 million worth of its customers' losses on April 20th. The day when prices plunged below zero for the first time ever. Retrospectively, there are 4 main reasons for oil futures collapsed to below zero. 1. The U.S. oil market had insufficient demand because industrial and economic activity grinding to a halt as governments around the globe extend shutdowns due to the swift spread of the coronavirus. 2. In 2020, the oil oversupplied because all net year USA started to produce more oil than Saudi Arabia. Under this situation, the OPEC were not willing to reduce their oil output. OPEC believed that any reduction will result in giving more market to USA oil producer. 3. Oversupplied last so long result to storage levels sprinting to the brim. For bulls are retail investors, they are not able to take delivery of physical crude. 5. Wall Street take action to kill the bulls. You may think that this incident will never happen again. But I want to tell you that you are wrong. A simple fundamental analysis to supply and demand situation let me believe that this kind of incident may happen again. 1/virus and recession are common and used to occur around every 10 years. Insufficient demand will occur again when new energy supply catch up and electric car replace tradition car. 2/The oil market seems to oversupplied soon. United States oil production raised to a level that it want to renounced plans to reimpose oil sanctions on Venezuela. This action means they no longer want oil from Venezuela. After the incident, U.S. oil production dropped to 10 m barrels per day. USA had then increased its production to a level that exceed the quantity in 2020. The production by USA is still increasing every month. USA recently produces more oil than Saudi Arabia. The 12-member oil cartel and its 10 allies decided to extend the level of overall crude oil production, starting January 1, 2025 until December 31, 2025. I believe that situation will change after the $11.2 billion Aramco shares sold to foreign investors. Sooner or later, the OPEC will not willing to reduce their oil output to give more market to USA oil producer. Angola has announced it is leaving the oil producers organization OPEC over a dispute on output quotas. If you enjoyed this video, please click the like button and subscribe to our channel. Thank you.